I think we're good, Nanette. You don't obviously need to call the roll
Oh,
since we
I'm
were
sorry.
already on.
I was just checking with Dan. Is it live streaming?
It
I
just started, I think.
Okay.
We are live now.
Okay, great. Thank you. So Lori Martin?
Here.
Sorry. Thank you.
I think first order business on the agenda, the governance calendar, is that John Tudrin, or is that our partners?
Yeah, no, that's our partners.
Okay.
Matt and Mike can run right with that.
Okay.
Perfect. And good afternoon, everyone. Thank you for having us. I'm going to just share my screen right now. Everyone should be able to see my screen. Perfect.
Yeah.
So just as a reminder, each quarter we focus on a different area of planned governance. This quarter being the third quarter, lower right-hand side on page 6 is the actual governance focus quarter, where we'll be looking at the investment policy statement as well as stewardship best practices. So when we look at your investment policy statement, you'll see on the left-hand side of the page here a lot of green check marks. That is what we like to see. So these are some of the key areas that we look at all IPSs really we think should have, whether it be investment objectives, really outlining the roles and objectives clearly, responsibilities, selection, monitoring, and termination criteria for your managers. So you'll see those sections all have green check marks. You'll see 2 items that are not checked off in green. They have red X's there, a spending policy and also proxy voting. No areas of concern there because there is not a traditional spending policy for these pools. That's why it is not memorialized in the IPS, as well as proxy voting. We're using institutional mutual funds and the managers are voting the proxies in your best interests. So that is why that is also not in the investment policy statement. The other 2 areas that have NAs next to them, also not an area of concern. You can see liquidity guidelines. These are for some of our clients that have a large portion of their assets invested in private equity or illiquid investments. This is just an area that we would like to see memorialized in the IPS, given that neither portfolio is investing in private assets. It does not need to have a dedicated section within the IPS. We've also listed out the investment policy statement in the following pages. We do not have any areas for change or recommendations at this time.
Matt, small note, Lori, just for context, that ESG element on the prior page, we took a position in the short-term investment, 10% using the TIA CREF Social Choice Fund, not because of pressure, not because of questions. And we took that, I think, some time ago. I don't believe we changed the investment objectives in service to that. It was sort of more of a position. So that would just be a little bit of context, Matt, that I would offer to our trustee on that idea of ESG consideration.
I guess my only question with that, Matt, is that fund is reviewed along with all other funds for performance and everything else, just as you would any fund, right?
Correct. It also carries our maintain status, and we do use that fund in other settings across our lines of business.
Okay.
So just moving ahead to the second part of the governance calendar is just a review of what we believe are committee best practices. Confident to say that this group is following many of these best practices, so no areas of concern. Just highlighting a few on this page here as an example. Under the governance section, middle half of the page here, meeting frequency. We're meeting on a quarterly basis. Very well attended meetings also. Meeting preparation. There's meeting minutes going around. That's very important that there's a record of what's happening. We're following the investment policy statement, and also the materials are sent out well in advance. So no areas of concern here on this page, more just an educational piece just to keep this area in the forefront of people's minds. And then just always, we like to put a collateral page here, a lot of great thought pieces that our group is putting out on the endowment and foundation front. All these are hyperlinks and will bring you directly to those articles, whether it be a blog post or a webcast, etc. Any questions on the governance calendar before we jump into the capital markets?
Nope.
Perfect. Seeing none, we'll transition to page 18. Before we get into it, into the report, we did see a lot of volatility within the third quarter. And I think some of the contributing factors to that volatility were we saw persistent inflation. We did see the staircase approach coming down since last June. But in the third quarter, we really did see it settle off in that, we'll call it 3 to 4% range. We also saw tightening monetary policy around the globe. We saw conflicts arise overseas as well. But one of the main contributing factors to the volatility that we saw domestically was the Federal Reserve's narrative change around their interest rate raising campaign. Over the last 18 months, we've constantly heard about them increasing interest rates to bring down inflation. Well, during the third quarter, that messaging changed to the narrative, we're going to keep interest rates higher for longer. And this is the thought process of we want to give the economy a chance to really digest these higher interest rates and not just really chasing these higher rates to force inflation down. Well, this brought a lot of questions to us about, well, how do markets generally react to this stance once the Fed does pause? So what we did is produce this graph, upper right-hand side of the page. We went back and looked at the last 5 interest rate raising campaigns and looked at the time that the Fed paused and looked at the capital markets 3 years out and what was the performance like. So we highlighted 3 different areas of the market, the first being the aggregate bond index, which is a nice proxy for the US fixed income market. The next being cash by the 1 to 3 year T-bill or 1 to 3 month T-bill. And the last is the S&P 500. When you look at the bottom here, looking at the averages across each one of the segments, you can see overall very nice absolute returns and across very different investing timeframes, whether it be in the mid-90s all the way to the most recent time frame of 2018. You can see the aggregate bond index up 7.8% on average, cash up 3.6%, and the S&P up 12.3%. So really nice to have these data points, really keeping in mind of the long-term perpetual pool that we're investing in here as well. Another byproduct of the Fed increasing interest rates has been tough for short-term minded investors with fixed incomes, really taking it on the chin. As we know, when interest rates are increasing, bond prices are decreasing, but it has brought back income to the fixed income equation. And that's really shown nicely here. What we're looking at is the S&P 500 earnings yield represented by the dark blue line and the Bloomberg aggregate bond index's yield to worse. For the first time since the dot-com bubble in 2001, these are actually converging. So that's a very interesting spot right here. That just shows a nice entry point as well for fixed income investors being paid again to owning fixed income. So that's a nice data point there as well. Lastly, talking about inflation, we did see it come down, as I mentioned, but we're stuck in that 3 to 4% range. One of the byproducts of that has been the oil market. We did see oil prices rally quite considerably in the third quarter. Now they have backed off those highs in the month of October, but that did help keep inflation somewhat high. Then lastly, just on page 19, upper left-hand side of the page, looking at US real GDP growth, you can see when we came out of those back-to-back negative quarters, we've had very stable growth throughout these timeframes, whether it be the last year, and then also looking at the print that we just had come out over the last week, very strong results again, beating expectations also. This is one area that we are looking at very closely, as a lot of pundits are saying now that they're anticipating a potential slowdown early 2024. So this is just an area that we are closely monitoring internally on your behalf. Any questions on the market themes or economic review before we look at the individual market returns?
Yeah, Matt, can you go back to 18 again on the bottom left? So does that, where we are now, is that kind of, I don't know, is that a forecast of 99 where things go in the opposite direction? And
Yep, no, that's a great question. I think it's a nice point to really think back where we are now. And is it a good time to potentially take some risk off the table?
Mhm.
So it's actually a nice preview to a couple of comments we had for later in the presentation, but we can talk about it briefly now. During the fall time, we revise our capital market assumptions. This is when we're looking at all of the individual asset classes for modeling purposes. And this is when also our discretionary committee gets together and really underwrites all of the portfolios from an asset allocation standpoint. So that would be potentially an area that we're looking at saying, we've been on quite a run here as of late. Fixed income, you're getting paid pretty nicely currently. We're looking either at the 10-year or even a little bit shorter on the curve here. It might be time to take a little off the table on the equity front and invest within fixed income. If there's not any other questions, just looking at page 20, left-hand side of the page, dark blue bars are the fixed income returns. And just as a reminder, the circle represents the third quarter results and the bars are the year-to-date results. You can see the third bar in is the US core bond market. This is the aggregate bond index. You can see for the quarter down 3.2%, but on the year-to-date basis, slightly better, down 1.2%. And as I mentioned, we saw an increase in interest rates, quite dramatic in the third quarter in particular. And as interest rates are increasing, bond prices are decreasing. So this was a major headwind for that segment of the market. But as we transition to the middle half of the page here, this is the equity front. You can see for the quarter, negative across the board, but on a year-to-date basis through September 30th, positive, really being led by domestic large cap. You can see up 13% for the year-to-date basis, really driven by those large cap technology names, followed by small cap being up 2.5%, international develop up 7.1%, and you can see the trailing index with emerging markets being up 1.8%. China's really been a headwind and a consistent headwind throughout the calendar year for China or for the emerging markets, as the reopening play has really not developed as a lot of investors thought it would. The one area for the third quarter that was positive, as you can see here, nice return is commodities up 4.7%. Really driven by the rally that we saw in oil prices. Any questions about the capital markets before we dive into the portfolio? Nope. Perfect. So looking at page 31, top half, you can see the results for the long-term portfolio. We'll start off by looking at the quarter. You can see upper left-hand side, right where my cursor is. Portfolio is down 3.4%, slightly trailing the blended benchmark, which was down 3.2%. When we transition over to the year-to-date time frame, you can see the portfolio is positive, up 4.8%. And as we transition to longer dated time frames, you can see on the 1 year portfolio is up 12.8%. Slightly trailing the blended benchmark at 12.8. But as we go over, you can see some consistent outperformance versus the blended benchmark on the 3 and the 5 year. On the 3 year, the portfolio is up 1.2% over the blended benchmark. So nice performance overall there. What does that mean in dollar terms? Looking at the lower half of the page, portfolio finished off the third quarter at $25,759,000. That represents an investment loss of approximately $918,000. Just transitioning to the investment managers, we'll keep this high level from a asset class standpoint. Fixed income on page 34, the shadowed line. This is how your aggregated group of managers performed versus their benchmark. For the quarter, they were down 3%, protecting slightly versus the broad fixed income market, which was down 3.2%. But as we move across to longer dated timeframes, you can really see the nice relative value that they have produced, such as on the year-to-date basis, down 0.6% when the broad fixed income market was down 1.2%. Similar story on the 1 year, up actually positive 1.6% versus the benchmark that was only up 0.6%. I did want to highlight one manager within the fixed income asset class, and that is Metropolitan West Total Return. This was actually elevated to our watch status during the quarter. And just as a reminder, we have 4 internal statuses. We have maintain, discuss, watch, and terminate. This was elevated to our watch status because 2 of the portfolio managers announced their retirement. The first being Laird Lehman, who will be retiring at the end of this calendar year. The second being Stephen Kane, who will be retiring at the end of 2024. Now, these are well telegraphed retirements, but given that both of them are announcing at the same time, did raise some concern for us. And also a third portfolio manager did retire about 2 years ago. So it is a lot of change in a short amount of time, but we do have an analyst actually conducting an on-site today in California with the team, doing a deep dive on strategy, philosophy, and really looking into the transition plan. The individuals taking over both of those responsibilities for the portfolio managers have been on the team for a very long time, and they'll continue to utilize that team approach at the portfolio manager level. One other manager just highlighting within fixed income is Brandywine Global Opportunities. This was elevated to our discuss status, so 1 level below watch. And the reason for this is the head of macro strategy at Brandywine did announce his retirement as well. A lot of retirements are going around right now. This is Francis Scotland, and he'll be retiring at the end of 2Q 2024. So plenty of leeway here. Just wanted to bring this to your attention, just because this is a overarching macro fund and has a lot of global parts going on. Dr. Cook, do you have a question?
Yeah,
Yes.
and again, more just checking for clarity, not because of performance, even though
Not because of performance.
these
Yes.
benchmarks, I see the 1 year as obviously much closer. So not
Yeah, if we looked at this manager about 3 months ago, it would show a completely different story. As you can see here, for the quarter to date time frame, really did struggle. 2 things caused this. The dollar rallying in the third quarter was a big headwind for this strategy. And the second being they have a much longer duration profile than their benchmark. So we compound that with rising interest rates and a long duration profile. That was a definite headwind for their style of investing.
What are your thoughts on their rank, though?
We look at this rank was very different 3 months ago. So
Okay.
Yep. No, yeah. But when we look at them over longer periods of time, we're very comfortable with them.
So the 57 and the 72 out at 5 and 10 years?
Yes. Yep. Yeah, I think this is very endpoint sensitive, especially with the quarter.
Okay.
Quickly within domestic equity, both of your small cap managers continue to perform very well on your behalf, performing ahead of benchmark. International continues to perform very nicely as well. For the year-to-date timeframe, up 6%, with the benchmark being up 5.3%. And then within real assets, we had one other status change, and that is within Cohen & Steers Global Realty. If you remember when we talked about this strategy a couple of quarters ago, it has a 2 portfolio manager structure. They are slightly changing this. Jason Yablon will have the final say in all of decision making, but they are still going to have 2 portfolio managers on the strategy. This will be effective on January 1st, 2024. So just keeping everyone apprised of the situation. We don't think this is really going to impact overall that much within the framework of the organization. Just wanted to make everyone aware of it, though.
Matt, can you remind me the difference between discuss and watch? And then
Yep.
Yeah.
Not a problem. So maintain is everything is fine, normal business as usual. Discuss would be a perfect example is if a manager was just retiring a year out, it was a single retirement, nothing else is really happening with the organization. A watch could be a performance related issue, or it could be they changed their philosophy mid-cycle when we think they should really perform great in a very specific environment, and halfway through they change it and they did not meet our expectations. The next could be two portfolio managers retiring at the same time, as an example is Met West. And then terminate is something egregious happens and that no longer is meeting our standards, and there's a multitude of reasons that could happen. And then also there's one other caveat. Our watch status can only be in place for 4 quarters. At the end of 4 quarters, it is either going back to maintain or to terminate.
Okay, that was my next question. Okay.
All of our statuses are complex wide. It is not just a status for the Springfield portfolio, but it is a complex wide. Any other questions? And we can dive right into the short-term pool.
Matt, can you speak to the rankings for the Hartford Emerging Markets Fund?
Yeah.
It just looks in the 3rd or 4th quartile over the past few years.
Yeah, so they've had a tough go, being completely honest, especially this last calendar year, and then actually last 12 months. So as an example, you see on the quarter down 6%, benchmark is down 2.9%. We transition out to the year-to-date time frame up 0.7 versus the benchmark that was up 1.8, really due to them being underweight India, overweight China, and also they were overweight China tech and China consumer names. So when we think of that dynamic, India has been a driver in emerging markets from a performance standpoint. They're underweight. China has been the worst performing area, or one of them, in emerging markets. They were overweight. And the spending within the Chinese economy with their reopening play has not been there. And if you're overweight the consumer names, it was a really big headwind for them. But you're right, the longer dated time frame here, when we're looking out to the 3-year, you can see it's being negatively affected by the last year and a half. Right. So bottom half results from a peer group ranking.
Okay.
Just jumping ahead to the short-term portfolio, looking at page 46. Upper left-hand side of the page, you can see for the quarter, the portfolio was up 1.1%, slightly ahead of the blended benchmark. But we look to the year-to-date time frame, portfolio is up 3.6% versus the benchmark at 3.1%. And then also on the 1-year period, up 4.7% versus the benchmark at 4.1%. So very nice performance given the mandate, really taking advantage of what the yield curve is giving us right now. What does that mean in dollar terms? You can see as of September 30th, the portfolio had an ending market value of $8,136,000 with an investment gain of approximately $89,000. One area that we were looking at coming into the new year about potentially changing was adding in a little bit more duration to the portfolio. You can see we've had a strategic underweight to the TIA-CREF social choice bond. This is what Dr. Cook was mentioning earlier. This is the ESG fund within the portfolio. You can see there's a slight underweight here, about 3 percentage points. And you can see this has really been represented in the MMDT cash portfolio, which has about a 3% overweight. So if we were to make any moves coming into the new year, it would be to really bring this back down into its target asset allocation, owning slightly more duration in the portfolio.
Matt, do you have in here what the actual overall duration is of the portfolio of the short term?
We don't have that as a stated page here, but looking at the individual managers, it is quite shorter than the ag. The ag, just call it, is 6. I would say this is less than 2.
Yeah,
That would
I would
be-
even say
I would
less than
a year and a
less than
half.
1 year.
Yeah, I mean, this is very short.
Okay.
And then just quickly looking at the broad performance page on page 51, all the managers are on maintain in the short-term pool. All managers are doing as anticipated in this environment. And we have a broad proxy here, just as the fixed income benchmark as the aggregate bond index, year to date up 3.5% versus negative 1.2, just to give you some perspective of what a broad fixed income mandate would be producing in this environment. Any questions about the long-term portfolio or the short-term portfolio?
Maybe more historical. Any reason why we don't have the social choice in the longer term portfolio? Seems to be a little bit of noise for a short term portfolio.
I think that's me. I'm looking for if Mike Chase is still on.
I'm
It's,
here. Yep.
I think that it was a hedge within a hedge, Lori, right? It was,
Okay.
let's demonstrate something, right? But it's I don't know if the technical term is it's a dog, right? But it's kind of always been a bit of a drag for us. And I don't know that, I certainly didn't have the courage to like call it back forward and say, because we lose a little bit of money on it. I don't know that the bond work in it ever really did what it needed to do given the different conditions we've had, but I'm not beholden to it, right? I just felt like it was a place in case we ever needed to have a start of a conversation as an institution.
Yeah, I guess I would just say the historical context there, Lori, was there was a desire to have some sort of acknowledgement of ESG without having a dramatic impact in the portfolios. Kind of the spot to do it was in that short-term pool. When we started with the short-term pool, right, a very different rate environment. We were like clawing to try to earn 1% there if we could. So it kind of fit that role in stable, very low interest rates. We had talked about it, with the expectation that rates were going to move up, that it's likely a headwind based on the overall objective of that short-term pool. Decided to retain it, but bring the allocation down a little bit just to mute that a little bit. The other managers have generally offset that. It's still not really impacting the strategy to an extent. And I think Dr. Cook, it's a fine strategy. I mean, if you're trying to get ag-like exposure with an ESG bend and a little bit of a proactive tilt, it's done just that. It's a little bit more duration than you would typically have in a very short-term oriented approach. But to Matt's point, now that we're in a very different rate environment, kind of bringing it up back to the 10% target, and if it's something that we wanted to kind of continue or maybe extend or grow the ESG component, we could certainly do it. But that's kind of the context about it. So I would say it hasn't necessarily been that the strategy's been a dog. It's more just been having that type of duration stance in this rate environment has been a detriment. But we've been able to offset that with kind of how we built the rest of the portfolio around it. So it has not been a huge impact on things.
You're very kind. Thank you.
Those were our prepared comments. Happy to field any questions that anyone might have.
Lori, any questions?
No questions. I'm just and we can talk later too, just about just the philosophy, because I think there's other ways to get at ESG exposure versus a fund, but it's kind of can talk about that.
Happily, and again, Matt Fortini, Mike Chase, thank you. Your thoroughness is phenomenal. Again, Lori, this is a relatively new phenomenon, the idea, right, of investments for us. If you look back, inception, that's a real date. I want to say 2014, if I'm not mistaken, was when the Board of Trustees really moved to diligently invest reserves in this manner. So this is still very new for the institution. And again, I think it has certainly paid itself off, especially with the way that we've been able to sort of build up that dollar amount. And don't call on it, Lori, as a revenue source. We kind of got out of it from operational standpoint. Obviously, that's changed a little bit, and now we've sort of redirected it for capital in particular. We use it as a hedge within the budget that we set out, but have not had to draw on it, had to do a divestment in some time.
I guess speaking of that, Dr. Cook, any update on building project, any potential liquidity from these that we need to think about? The only reason I ask is that it's 90% liquid at any given time, but we do have that one hedge fund piece, which is a little bit of a lead time to it, and just in the market environment we're in, right? If we know we need to plan around something, we can obviously make adjustments. So any update on that would be helpful for us.
I'm looking at Andrew Nathanson and John Tudrin. I want to say, because these dollars are last dollars on our capital project, I can't even imagine that we're a year away. We still may be 2 years out from when we need to draw on this and do a true divestment. I think we're that far away. So however that really helps shape Mike and Matt, considerations, Lori, when we're really looking at strategy, map to policy, I think we've got a lot of room to maneuver here. In other words, we're still in the design phase, right? We still haven't even gone to like construction bidding. So truly plenty of time.
I guess any old business, new business, is that?
That would be you. Anything,
Okay.
Madam Trustee?
No, I don't have any. And the date of the next meeting is Thursday, February 1st at 4:30. And I guess entertain a motion to adjourn if no one has any questions or comments. Approved.
Right. Thank you so much. Thank you, Lori. Thank you, everybody. Good to see you.
Thank you.
All right.
Thanks,
Take
all.
care, everybody.
Have a
Bye-bye.
good
Thank
night.
you. Take care.